What's going on, guys? Today we're going to talk a little bit about what it looks like to invest in real estate. We're going to scratch the surface on that, so stay tuned. All right, so you may have heard or Googled that there are two different types of real estate residential investing. One is a buy and hold, and then the other is a fix and flip. As you can probably tell, a buy and hold is something that you're going to purchase and hold on for a long time. You're going to rent that property out. And a lot of my investors that we personally serve on our team are looking for a certain percentage or a ratio, if you will, for a return on their investment per month. What that means is if one of my investors is purchasing a house for, let's say, $200,000, and the house is, let's say, roughly 2,100 square feet, a 3-bedroom, 2-bath, then what he's wanting to do is he's wanting to get at least a 1% ratio back out of that of what he's purchased, meaning putting 20% down on that home. It's very important to know that if you're going to invest into a secondary home, meaning a home you don't currently live in yourself, it's not your primary residence, in the state of South Carolina, you're actually going to pay a 6% tax rate as opposed to a 4% tax rate. What that does effectively each year, your taxes are almost going to triple depending on which zip code and county that you live in, or the county that that house currently is. So looking at the rents, for example, again, he paid $200,000 for this house. He's wanting to at least get a return of $2,000 per month on that home or more, so that his cash flow, if you will, on that is superseding what his mortgage payment's going to be. Especially remember that those taxes are going to be taxed at 6% instead of 4%. So it's going to be a higher mortgage payment, and that's why the bank is specifically going to want you to pay 20% into that home as a down payment, because then the bank is at less risk because it's a secondary home that you are not going to be likely to default on. Next, we're going to talk about the fix and flips. The house that you're going to purchase needs to be substantially less than the average price per square foot typically in the neighborhood that you're purchasing. Reason being is because if you're going to fix and flip this home and make any money on it, you're going to need to do some repairs. So let's say it's cosmetic stuff, maybe some siding, fix the roof, maybe the flooring needs to be replaced, or let's say you're doing an entire gut job and you're taking the house down to its studs. You're going to need to purchase that home at a much lesser price tag as opposed to, let's say, an end user would to just move in, put their couch down and start watching TV. Reason being is if you, for example, bought a house for $150,000 and that neighborhood on average is selling between $300,000 and $400,000, then you have a very wide gap for what you can do to put equity into that house and update that home. Whether it's cosmetic stuff or it's structural things, you need to be aware of how much you're going to pour into that house and make sure you're not pricing yourself outside of that neighborhood. Now, before purchasing that investment property, you want to take a look at the average price per square foot in that neighborhood for a finished home that doesn't need any improvements. And then you need to look at the price tag that you're intending to purchase for this home and make sure that that price after improvements, or said as ARV, after repair value, does not exceed the average price per square foot in that neighborhood. Keep in mind that each investor goes into each deal with different expectations. So today we just scratched the surface on what it looks like to invest in real estate. So if you guys want to dive in deeper for what it looks like for your specific goals, feel free to reach out to us, visit us on our website. And remember, with Delisle Properties, luxury always comes standard.